In this market update, I'm going to be talking about why earnings are important, but even more important, why the quality of earnings is important. Hi, Jim Gore from THOR Wealth Management. It's very important to look at earnings, but it's really the quality of earnings that's even more important. And what we've seen recently, we've seen some reports coming out, whether it's a Wall Street Journal or this Bloomberg quote, talking about the quality of earnings is not as good as it's been in the last several decades. And what we're talking about here is quality of earnings is the earnings are being adjusted to make the company's earnings look better, and more CEOs are doing that. That is reflected here in this chart. This chart here is looking at GAAP earnings to non-GAAP earnings or operating earnings. Also, another way to look at it, you go to CNBC and someone comes out with earnings, you always see ADJ, adjusted earnings. Well, this is what they're doing. They're adjusting their earnings, taking out things, supposedly non-recurring items, but they're doing more and more of that. And you can see the gap right now is the widest it's ever been since 2008 and 2009, when there were an awful lot of write-offs from companies because they were losing some money at that time. But more importantly, you see that chart has been moving steadily up in the last several years, and right now it's at its highest level. So this is what they're talking about, with the quality of earnings are not nearly as good as what they were 3 decades ago. And one of the things that really gets in our craw is that these non-recurring items, one of the things that you always see that is reoccurring, but they always take out on an adjusted basis, is employee stocks that they give out. And this is just looking at the tech sector. And this is according to Barron's earlier this year. They talked about 4.2% of revenue back in 2012 went to stock compensation in the tech sector. As of the end of 2021, it was 22.5. So we're looking more than a 5-fold increase in stock compensation. And then to take this out of earnings, that really doesn't make sense to us. And let me give you a really good example here. And this is just one example of a well-known company. It's a great company. It's a growth company that all of us are probably familiar with, and that's Salesforce. And as we say, it's a very well-run company. It's a good company with great products. But you just have to understand what you're buying and how the earnings are being adjusted. So this is actually looking right from their May 31st earnings report, that press release that they had come out. You can see here all the way in the right-hand column, for a forecast for 2024, this is what they're having for earnings. They're sitting there saying that the GAAP earnings are going to be 267 to 269, average it out 268, and non-GAAP is $7.41. It's a huge difference in there. Now they're taking out some things in there. The biggest one that we see is the stock-based compensation. They're adding that back in. So in other words, the stock that we're giving to our employees really doesn't matter for earnings. Well, as a shareholder, it does. If you're giving away the company stock and diluting my shares, I want to know about it and I want to account for that. Here they're taking it out. And why is this important? If you look at this right here, this is looking at the PE ratio of Salesforce. For PE ratio in 2024, you look at the non-GAAP earnings of $7.42. You take the price of the stock right now, PE ratio, price earnings ratio. Stock is roughly $208 a share. That's the timing of this, making this video. It could be different by the time you watch this video. But the earnings of $7.42. So in a non-GAAP operating earnings, it's selling for 28 times earnings. GAAP earnings, if you look at it, 208 divided by the 268, the midpoint, it's selling for 77 times earnings. So you have a big divide here on what the fundamental value is, the price divided by earnings is. And this is why CRM or Salesforce has had activist investors in the last couple of months come in, and they want to make some adjustments to get that operating profit margins up. And part of it, what their discussions is their employee stock compensation, and they're trying to address that, which is good from a shareholder perspective. What's even more important is to look at a company's revenue growth, their actual cash flow that's coming into the business, and their earnings. You have to make adjustments in there, and we do that all the time on the investments that we're putting our clients' money into, so that we have a true earnings estimate for what they're going to be in the future. A lot of times, and this is why it's important for those individuals that are not active investors or understand the financials, to not just look at a PE ratio and invest in it. There's a lot more that goes into investing into a company. As I say, you want to look at growth rates, you want to look at fundamental values, and you want to make some adjustments on items that have taken place or that they're in their GAAP earnings. And we make those adjustments as all good financial analysts do. If you have any questions or you need any help, please email us at thorwealthmanagement.com or give us a call. Take care and talk to you in a couple weeks.